Hi, everyone. Bill Fairman with Carolina Capital Management. I'm here with Jonathan Davis, who I can't touch because we're supposed to be separated.
Get a little more space there.
And
yeah.
Once again, just like last week, the camera always puts extra pounds on you, so we really look closer than we are. So we're definitely at a safe distance. It's time for another market update. I want to introduce our guests around the horn. We're still waiting for Mike's, but we got Mike Slotnick of Tempo Funding. He'll be joining us shortly. Jacob Vanderslice of Van West Partners, Glenn Strongberg of Strongberg Investment Group, Fuquan Bio of I don't know why I always get so hard to say this, Fuquan, NNG Capital, Chris Miles of Money Ripples. So let's get this train wreck going. So, guys, there's and we'll talk about the CARES Act, and it's also called the Paycheck Protection Plan, or
PPG,
something like that.
Something like, yeah.
We'll talk about that in a little while, but right now people are talking about liquidity, hoarding your cash, waiting to do things. I mean, I'm a big proponent of making sure you have plenty of dry powder.
Absolutely.
So I'm going to start this off with Chris, and then we'll go around the horn. For real estate investors with hard assets in place now, you know, they may have hard assets, but they're looking for liquidity. In your opinion, what is the best way to get liquidity or to get liquid now, especially with the markets and kind of how they're paused?
You know, it depends on which hard assets you have. I mean, if it's real estate heavy, you know, it's actually in some ways kind of a seller's market right now, where depending on the price point and what kind of property you have, I've noticed like in the single family space, like there's people still having bidding wars right now over properties, because with the virus and everything, people have pulled their properties off the market, which of course now allows less properties to be there. So it kind of allows you to stand out before people put them back on. So I think that's one of the great ways to do it. Again, I've been a big proponent of, while you can, try to get equity out of properties, including your own home, you know, things like that, just so you have that liquid cash available. You can always pay back the loan later, but cash is going to be essential during this period of time.
Excellent.
Thank you.
How about you, Fuquan?
Yeah, I definitely agree with Chris. Lines of credit, you know, if you have good rates on your credit cards, you can pull cash from that. If you have equity in the property, you can reach out to private investors and try to create a short-term lending opportunity from private investors. There's still a lot of investors who got hurt in the stock market and looking for opportunities in the real estate alternative asset world. So, you know, if you can attract that private investor and structure a short-term lending structure for them, I think that would be, you know, beneficial to give you the liquidity and also give the investor a short-term opportunity.
Well, you know, that's a good point there. I didn't think about this too. You can actually sell some options if you own a bunch of property.
Yeah,
you could sell some options to folks and create a little bit of liquidity that way. Glenn.
Yeah, really same thing. I would say, you know, like lines of credit, obviously, I think it's a good thing to take them right now. Why banks are still, you know, if you have them, take them. You can always just pay it back if you don't need it. And then there is a lot of private money out there. I'm getting like about a call every day now from people who are getting burned in the stock market. So there's a lot of private money out there, and I think there still is a lot of commerce, and you know, you can structure deals with private lenders and free up equity out of houses, and you know, those are the two ways that I would do it.
Yeah, and we'll talk about the opportunities, you know, in our business, in the alternative space, the real estate space, in a little bit. Jacob, you're up next. What do you think?
Yeah, we've already touched on lines of credit. That's an obvious one. But if you don't have a credit line now, it's probably going to be hard for you to get one. So we're focused on private debt and private equity. We're seeing a lot more of that available out there right now, even as the credit markets feel like they're seizing up. To your point, Glenn, people are getting tired of the boom and bust of the stock market, and they're moving their investment accounts into hard assets that create current cash flow. So we're staying liquid by being responsible with our leverage, pulling on our lines of credit, and just raising additional private equity for our deals.
Excellent. Mike, I'm going to tell you the question since you just joined us. The question was, if you have a lot of hard assets, but you're kind of cash poor, what's a good way to become more liquid?
It's a great question. The number one exercise is go through your relationships, identify folks with capital, and talk to them about selling them some equity. Excuse me. So the possibility to take on a partners to achieve liquidity is not a bad idea if you can get access to lines. So bank lines are frozen, most of them. Well, sorry, they're not frozen. The new lines going to be hard to get. The existing lines. What's most interesting is if you have a relationship with a bank and you have strong track record and you have the right balance sheet, you may actually get your line increased. I mean, that's the experience with us. Our banker is likely going to increase our line. But if you don't have a line and hard to get bank money, you can try to find private partners to sell them some equity or lend you against the equity. There are a few sites out there, kind of. I've not used them, so I can't give you any other comments other than they exist. Institutional players try to buy equity in your property. There's a point.com, just give you an example. They basically give you essentially hard money rates, expensive money, and then they buy a piece of your equity. But it's an access to liquidity. If you can't get lines of credit from banks, if you don't have existing lines, you can't find private buyers to step in and buy a piece of your assets, then you wind up going to some of these third-party shops. But I do know that they operate, and I've received some of their letters on the properties where they want to buy a piece of your equity. So it's a liquidity, probably not the best price, but it's a consideration.
So are they going in as kind of equal partners based on a percentage of what they're doing, or is it more like a
So the point.com is one of the shop. There is also is another one. What they do is, if let's just say you own, let's use an example, an equity, a property that's worth $1 million, and you have only $500,000 mortgage, so you have $500,000 equity. In theory, you could sell them, say, $250,000 of that for 50% ownership.
Okay. All right. Nice. So I noticed that you were sneezing a little bit there. Please tell me you got allergies to that cat of yours.
Yeah, I'm in New York. It's a little scary nowadays, so I don't know. Hopefully, I don't have the coronavirus. I don't have the fever. That's the good news. I have a little bit of seasonal allergies. So
because there's plenty of people that still get the cold and the flu.
And that's the allergy season, and I have severe allergies during the season, and I usually get allergy shots, but the dock is closed. So
yeah, no, I get that. Thanks for your answer. By the way, like, share, and subscribe. Also, if you have any questions, you can go into the chat and ask questions. We'll answer them here on air if we can get to them. So it's pretty easy to ask questions. All right. So, Jonathan, you want to?
Yeah. The next question we have will be, if you are liquid right now, do you continue to wait and see what happens, or are there selective deals that you would consider? And kind of what are those, whether they're purchasing, whether they're lending? What are you all looking to do given the current climate of where we are?
And who you going to pick anyone in particular?
Yeah, and then we'll start with Chris.
All right. Well, it depends. I mean, I think it's both. I think you can definitely still have money working, but still keep some money on the side just for more opportunities as they're coming along the way, right? Keeping some of that dry powder. I'll tell you, right now, I mean, especially with the way the lending situation is getting, I think from a lending perspective, it's going to be a better deal even currently. For example, I'm trying to get a commercial loan right now, and the commercial market's almost shut down completely for real estate. Residential is fine, although the rates are higher, right? But a commercial is pretty much shut down for at least the next month and a half to 2 months. So, I mean, there's opportunities, I think, to be able to take advantage of right now. Yeah, I'm looking at both now and later. I think there's opportunities all the time. There's never a shortage of opportunities. I'll tell you that much.
Nice.
Thank you. Fuquan?
Yeah, I mean, it's really challenging. I mean, discipline and patience is what comes to mind. I mean, it's the last week or so, my inbox has been filled with different tapes or mortgage notes. It seems like a lot of people are trying to get liquidity and sell off some of these assets before the value of them drop even faster. So we definitely changed our buy box, and we're buying off of a lower percentage of fair market value than we were before, somewhere 20 to 25%. So we find something that fits, in that range. We're definitely going to execute, and we're being more creative also with the type of deal structures we're doing. We're really marketing buying on terms, as I mentioned in the last session we had, and trying to be a little bit more creative with the sellers and just giving them what they need right now as far as liquidity, and doing a lot of subject to. So, our buy box and the way we buy definitely has changed, but if we definitely see an opportunity that fits in the current climate, we're going to execute. We do know further down the road there will be an abundance of opportunity, but really practicing patience and discipline, I think, is important right now for smart money.
Great. Thank you. Glenn?
Yeah, I kind of agree with what everyone said so far. There's always opportunity out there, always. Like we've talked about before, the capital markets have froze. Prices are going to be coming down. I mean, I think we all know that to some degree. Prices will be coming down. So yes, we are still actively looking to buy properties every day, like we always do. But our offers are 20-25% lower right now. We're trying to find out where the market is. It just stands to reason with this coronavirus, people are not getting out looking at properties right now. They're not looking at houses. They will come down. We just got to figure out how far. So. But yeah, I think there's going to be tremendous opportunity, in the coming months, and just want to stay in tune with the market.
Got it. Thank you, Glenn. Jacob.
We're mainly focused on cash flow in our self-storage line of business, and we have deals that were under contract prior to the coronavirus, and back then those deals were good. But now we're reconsidering deals that were just good. We're really only focused now on deals that are home runs. And we're also trying to put ourselves in a position where we can buy these things with cash, with price reductions. For example, we're buying a deal in Panama City, Florida next week. We were working on getting our debt lined up. We've got it in place, but they can't close until later. And the seller wanted to, instead of closing later with debt, they gave us a price reduction to buy with cash. So we got a better deal on it. It's full, it pays preferred return, and we can be flexible on our financing terms without kind of a closing gun to our head. But in addition to that, we're really stress testing deals a lot more than we used to be. We're concerned primarily with the amount of money that the average consumer is going to have in their pocket as this whole crisis manifests. And being in the storage business, historically, it's been pretty resistant to recessions, but this is so new and so sudden and so fast, we just don't know what to expect. So we're stress testing with delinquency rates. We're stress testing with lease up. What's the deal look like if we don't lease up any of the vacant units for the next year? What's the deal look like if we get a 15 or 20% spike in delinquency because people are losing jobs and unemployment's going up? So really just trying to be flexible with our terms, buy time from sellers when needed, and really stress these things in all directions to make sure it's still a good acquisition decision. But as everyone's mentioned, we feel like big opportunities going to be coming in the next 3 to 6 months in the real estate sector. We're not seeing much of it yet. We're seeing some fear, but we're not seeing that fear translate to major price reductions. But that's coming. I know it's going to, and we don't want to buy an okay or decent deal today when we think there's going to be a home run deal in a couple months down the road.
Got it. Thank you. Mike?
So the word of the day is patience today. You have to be patient to get better deals. In agreement with all my colleagues here, there are some deals you can close on today. Give you an example, we had a deal with financing lined up with Lima One. They just backed out. It's a strong deal with as-is discount, very strong cash flow portfolio, but they backed out. So what do? Right now we're trying to negotiate on take it down with seller financing. Essentially come to the seller and say,
Yep.
Mr. Seller, if you want us to close, you got to write us the paper. We'll still bring in significant down payment as we were planning to do with Lima. but you'll have to carry the paper for a year probably. We don't know how long, but some amount of time until we can refinance. We just don't know how long it'll take for the markets to restabilize. So probably going to ask for a year or even longer. That's one strategy. The other strategy is exactly what Jake was saying and other ones. The deals today, they're beginning to look better, just beginning. But some are already happening. Like Fuquan or Glenn was saying, they can get acquisition price reduced by 20-25%. And if you can do that, that's enough of a safety margin to go into the deals. But commercial deals, when we do participate in many commercial deals, take time for the paint to shake in, and that time is going to be probably a couple of months. So the spread between the bid and ask, what sellers want to take versus what the buyers want to pay, is significant now. It's widened quite a bit with uncertainty. The sellers don't want to give away the farm, and then the buyers don't want to overpay, and financing is not available. Yeah. So with those two things, the time is to be patient as a buyer and let the sellers accumulate pain when they're going to bring the paper to the market, whether it's a paper, it's a note, or actual asset. The opportunity will be greater in a couple of months rather than now, because at this moment, commercial players are able to defer or at least change their mortgages to interest only. They're working out with their lenders. There's going to be some level of cooperation, and there's nothing wrong with this. But there will be a point in time where the pressure will be so great that they're going to be doing two things: potentially selling assets at a discount, or two, as I mentioned earlier, taking on partners to provide them preferred equity to salvage the deal. Then you can come in at great terms and participate in the deal, coming in as kind of the last drop of the capital, having the most senior consideration at that point, having the safety, and get sort of the best rate of return on your money.
Yeah, I agree with you. I think we're going to see a heavy rise in seller financing. I want to follow up with another question here with you guys. And
well, before you get to that, real quick, we had an audience question I'm going to ask. What does a stress test mean? So I'm just going to cover that real quick. It means that you're going to take and stress whatever it is by a certain percentage. So if you, for example, are looking at cash flow, and you take 15% of the cash flow away or 20% of the cash flow away in a year, is it still a viable deal? And if it still is, then you probably have a pretty good deal there. Wouldn't you agree?
And then you say, with that cash flow and my cash reserves, if it does hit into a negative cash flow, how long can support this until, we can, move the asset out, with the market conditions.
Right.
So,
right,
So my follow-up question is, with everything that's going on right now, there's a lot of belief, I think, from a lot of different people in the market who believe that multifamily is going to take a hit, that there are going to be people who are working from home, let's say working from their apartment with their kids, and it's a little difficult right now, and that perhaps this will become the new norm, that they'll be looking for single family rentals or real estate rentals or, something like that. I'd like to get your guys' idea on those two questions. What do you all see happening with multifamily? And then what do you see with the rentals on single family? And I'm going to switch it back and go to Mike, if you could touch on that one first for us.
Sure. I'm going to start with my crystal ball broke and I can't find another one for sale. Right? Who knows? And you're talking about behavior changes. People who occupied multifamily apartment now suddenly wanting to buy a house, whether it's mobile home or a manufactured home or standard
or even rent it. Yeah.
Well, or rent it, right? So there is that possibility now that there's less comfort being in an apartment with kids, right? And that's the truth. It is possible, certainly, that there will be some increase in demand for rental or acquisitions of the single-family properties for that reason. But it'll come down to incomes, right? If people can afford an apartment, there's a reason they were in an apartment in the first place. They couldn't afford the house or they didn't want the house. So I would say that there's a possibility that there's going to be some shift to that but it's unknown. It's really a function of unemployment, jobs, and if they can't afford a house, they're going to stay in their apartment. That's the bottom line. And with recession, the demand for the least expensive product is going to increase, while the demand for housing could decrease, because if they can't afford a house and they can afford an apartment, by the same token, you can move into the apartment from the house. So it's unknown. It's hard for me to speculate.
Okay. Jacob, what are your thoughts?
Well, people are going to have less money in their pockets. We know that much. We have a relatively small residential portfolio. So far, everybody's paying. We had one tenant ask for $500 off and catch us next month. But this is the very beginning. So I have no idea. I think it's going to beat up kind of B-, C+ multifamily workforce housing. I think we're going to see a delinquency spike there. But this whole thing is just day by day. But the theme we're concerned about across all of our lines of business, whether it's retail, storage, or residential, is the American consumer's ability to pay.
Mm-hmm.
That is going down by the day, and it's going to get worse before it gets better. So we're monitoring that carefully.
Great. Thank you. Glenn, what are your thoughts?
Yeah, a couple thoughts on this. It's funny. I got a phone call from a good friend yesterday, and he said, "Man, you're going to be in the catbird seat." I said, "Why?" He said, "Well, people, multifamily." He goes, "I think it's really going to get hurt because of the coronavirus. People don't want to be around other people." And I never really thought of that, to be honest with you. But I don't know. I mean, it's just I think it all boils down to income, right? If people, they got to eat and have a place to live. So if all they can afford is an apartment, they're going to do it. I do believe, and that's kind of why I did the model I'm doing, that single family, in my case, double wide mobile homes on land are gonna, they're the most affordable house. So I think we're gonna be good long term there. It's if people got to have a place to live, but I think apartments could, once again, depending how bad this thing is and where incomes go, it could go either way. I'm not sure either.
Mm-hmm. Great. All right. Fuquan.
Yeah, I believe it's going to be something short term. You're going to see a dip. Vacancies. It's probably going to be a snowball of evictions once the court open back up, and all the people who played the system. It's going to be a dip, and I believe it's still going to be strong. I mean, it was a very, very high demand for that product before the Black Swan event took place. And, the next 90 days, like Lynn said, we're going to see the men from the mice, as they say, who can weather the storm and survive this. But that's a very hot product. Pricing is going to dip for sure, but I believe it will come back. 2021, we'll probably see, some new things happen with that. People always need a place to live. Like Lynn said, shelter is definitely one of the main things, and is whatever you can afford, whether it's a C+ or a B class apartment, it's going to be, your affordability.
Yep. Absolutely. All right, Chris, what are your thoughts?
I mean, like the financial reasons they said, I mean, it definitely, cash is going to be liquidated pretty fast. People are going to be in a crunch, but I think this is going to be more of a psychological trend that we might look forward to, right?
Yeah.
For example, it'll be psychological both from the individual and from a corporation standpoint. Because from the individual standpoint, are they thinking, hey, do I need more space? This whole social distancing, if this gets really dragged out a long time and this creates a lot of pain, if this really gets bad on the virus side, people might say, I might want to distance myself a little bit more from people. Also from a company aspect, I know there's a lot of companies, even tech companies, are realizing, wait, we can send people home, just even give them our office furniture to be a temporary lease. We can let them work from home. We can shrink our office space, shrink our overhead, and that makes it easier to work remotely. And if people can work remotely, it does change the aspect where many people do live in a lot of multifamilies, especially when it's closer to the city. They do that because they don't have to commute so much. But if they don't have to commute at all, it kind of opens up the possibilities of where they can live. So I think it just really depends. I think if there's a long-term effect from this virus, I could really see a more of a gradual transition, but I don't think it's going to be either or. I think there's still going to be a use for multifamily. There's still going to be a use for single family, but I think it's not too uncommon to see people start to spread out, maybe even go towards the interior of the country if they can.
You don't see manifest destiny going. Yeah, let's all sprawl out now.
Exactly. Yeah.
Okay.
Well, I'm going to give you my take on all this, if you don't mind.
Bill, it's your show.
Thank you. So I'm looking at this like you're looking at the weather, and you can kind of compare it to a balloon. You're going to squeeze on one end of the balloon, and it's going to expand on the other end of the balloon. So where you have probably B minus, C plus class property, blue collar workers, where you're going to have a temporary spike in delinquencies because they're going to be in a transition, but they'll be able to find work where they're losing perhaps jobs in some of the service sectors that are being hurt right now. There's other service sectors that are exploding. Yeah. And they need to hire people.
Logistics. Yeah.
So that part I believe is going to be temporary. What I think is going to happen is that you're going to see savings rates going up because people are going to be in the hoarding cash mode versus spending everything they have. So I think what you're going to see in the Class A type properties is if you have savings rates going up, consumers are going to be spending a little bit less. That means corporate earnings are going to be a little bit lower. And you're going to have people, I think, moving from Class A type properties to more of a Class B plus to B. Just why do I need to spend this extra money just because it's prettier?
So you're saying like a trickle up fiscal responsibility starting with the individual.
Not only that, in a lot of markets, they've really oversaturated the A class properties. So
that's true.
I think that might be an issue where the values of those start to come down a little bit, and the delinquencies, or not the delinquencies, but the vacancies go up in those type properties.
Yeah, they may not be the first hit, but I think that might be the longest lasting hit. Yeah.
Right. And then, Chris talking about people being able to move out into other areas, you're going to see a big spend in infrastructure to get really good high-speed internet out into the more rural areas. That's going to be the 5G with the wireless is going to be a big help in there. But you're going to have a lot of people moving. There's going to be a lot of jobs created just to get that infrastructure up and running. Yeah. At the same time, those people that don't have to have the, walk to work, walk to the pub, walk to shopping, those people are going to start moving out a little bit and spreading out the country, which is good because it will help with our congestion in these congested areas.
Awesome.
Okay, so let's talk about the Paycheck Protection Act, the CARES Act. We did get a little more clarity last night in the Freedom Founders town hall meeting. I want to let everyone know that's listening about this that don't quite understand it, but essentially you're able to get 8 weeks worth of your average payroll to bring your employees back, to rehire them, and then all of that is forgivable as long as you're using it for certain things. And we won't get into those details, but I want to ask the group, do you think this is going to actually help these smaller businesses, or do you think it may put them in a tougher position? So Mike, let me start with you. What do you think about getting these extra loans? Because they did reduce the term to 2 years from 10 years. So what is not forgiven is going to be a lot less to pay. I mean, a lot less time to pay in. So the payments will be higher. The good news is they dropped the rate down to 0.5%. So you think it's going to be beneficial to most?
So let me answer the question. There's still some uncertainty. Just got off the CG call. It's unclear what's included and what's not. So the W-2 payroll is pretty obvious. The self-employed people you paid with 1099, it sounds like it's not going to be included. They're going to have to apply on their own. And it's not really clear what happens with the partners if you paid yourself as a self-employed partner. So if you were a self-employed Schedule C person, I think it's covered. If you are a partner getting paid through K1 with other partners, even guaranteed payments, it's not clear whether it's going to be covered or not. So just one comment on that, on the uncertainty of that. As far as help, for sure it'll help, right? I mean, no argument. My wife is an optometrist. We have an office, and we're closed in New York. And whatever we can get to help pay the employees, it won't help our business per se, because we're going to pass that money over to the employees. It'll be essentially keeping them on payroll, even with office closed. It's a form of a sort of a subsidy. As far as how much, what portion of that loan will be forgivable, the chance is 100% of it for most people, right? First of all, they're going to limit how much they're going to give you, 2.5 months worth of payroll. In New York, even if we let some people go, and we don't have a big staff at my wife's optical, just using an example, the rents are so significant. If we pay rent, it'll cover the remaining 25%, but 75% has to go to people. This was a fast way for the government to send extra help to W-2 employees through the businesses. To the business, it helps small businesses keep the employees that would otherwise lay off, with the hope that after 2 months, the business is back to normal, or at least some kind of reopening, and you can survive. It's not great help, but it's a positive thing. Let me put it this way.
Excellent. What about you, Jacob? What do you think?
I certainly think it's going to help. It's got to be speedy, though. If there's a lot of red tape with the application process, if funding is delayed, it's not going to do what it's designed to do, and that's get money in the pockets of businesses so they can cover their overhead during this kind of really soft time we're all saying. I think that there's a lot of guidance that still has to come out on exactly what the rules are that Mike already touched on, but I think for the folks who really need it, people like our retail tenants, for example, who have furloughed people, their closed, their takeout sales are maybe 5 or 10% of what they might have been if they were open for normal business. It's going to really help those folks out, but I think speed is going to be critical. If businesses apply for this and it takes 2 months to get the funding, it's not going to do what it was designed to do. And I think what it's designed to do is buy some time. And everybody is just buying time right now. Government, small businesses, we're just trying to get through this week by week. And this will certainly help with that if it's speedy.
Glenn.
Yeah, I don't have a whole lot to add to what the guy said. It's certainly not going to fix things, but it obviously can't hurt. It's a good thing. It does depend how fast it comes out. I was on a call last night that they're still debating whether still trying to figure out if a self-employed person, a partner, can take his draws and counted for payroll. I'm still waiting to get a definitive answer on that. And I'm not sure about the contract labor, but that was another issue. They didn't think so, but they were checking on that too. But it's I don't know. I hate to say it this way, but I've never seen a government program fix something. But it certainly cannot hurt. With the conditions, we're in uncharted territory, and just like what Jacob said, I just hope that they process them fast, they get the money to the businesses fast. Otherwise, it's gonna, it's not gonna do much good.
Well, and thank you for that. You have to think about it this way too. If the government doesn't create wealth, it just redistributes it. So if they're taking it from one place and giving it to some other place, where are they getting it from? So eventually, we're going to have to pay it, and in my opinion, it's going to be paid in the form of more printed money and inflation. Which is going to end up helping our industry anyway, because our hard assets are, I don't want to say they're inflation proof, but they're a hedge against inflation. Fuquan, you got any opinion on this?
Yeah, I think it was a great move to put that in place. It's definitely going to help a lot of small business owners, give them an opportunity to float and keep their team and their staff on board. I mean, you can only imagine if you have to lay off half your team and you have to start all over again and go through that whole process, right? A lot of us have people who've been working with us for years, so it's definitely going to help the small business owners, get to that next phase, again, like everyone else said, just depends on how fast it comes. One other thing that people should be mindful of is making sure they use it for what it's supposed to be for, so they won't get into trouble and accelerate, the due date a little faster than that. So I think it was a great move, but again, if it comes quick enough to help out, then that would be the real benefit.
Yeah, I'm starting to hear that some bankers are pushing back on some of this too, because they are worried about liabilities that they may have. And then, frankly, what we heard last night was that some of them are still very confused about, the rules, and we only have till tomorrow when it opens up.
As most of us are still confused.
So, Chris, you have any opinions on this?
None.
Okay.
Not, of course I do. Is it a good thing? I would say that's a relative term, because I would say this: it's the lesser of two evils for sure. It's kind of like a plane spiraling to Earth. It's about to crash and burn, but instead we're putting wings on it, so at least it kind of glidens it, and we only crash a little bit. And I think that's kind of what I see, right? Like I see that this definitely helps. It helps the average worker and that sort of thing, and keeping money circulating, because exchange in the economy is the key thing.
Right.
But I think the hardest thing right now is we're seeing I think we're going to see a weeding out, right? Where the crash and burn would say, great, we just have to rise from the ashes, right? This situation is definitely better than that. I see this as more of a weeding, a sifting of the wheat and the tares. You're going to start seeing the companies that will they use it, to actually help the payroll go, or are they going down anyways because they have too much debt servicing going on in their companies? Are there other things? Are they trying to use that money to say, I'm just trying to stay afloat because of other expenses and other issues going on, or refund requests, or whatever it might be? So I see that this probably won't be enough, for a lot of these companies. For some, I think it'll be great, and they'll weather through it just fine. But I think this is going to be a little bit harder than some people are expecting. And the next question is going to be, are they going to do it again? They have to kind of keep pumping money out, and where's that money have to keep coming from? That's the thing that I'm scared of,
Right. Well, I mean, I agree with you. It's not exactly the ballistically deployed parachute landing that we would like to see. But, we had a lot of industries that were already over leveraged and, low margin type of companies that were getting fewer sales anyway. And I don't want to point out any particular companies. We'll just say let's say the higher end apparel, brick and mortar type of companies there. Those people were working with pretty slim margins to begin with.
Well, I mean, just think
the
about
overhead.
30% of all publicly traded companies don't earn more than their debt that they have to pay. So, I mean, there's a third of them right there that, this doesn't really probably help that much.
Yeah. Well, not to mention a lot of the new IPOs that aren't making any money.
Yeah, there's a lot of not making money.
And they don't project to make money for several years, and now they're not getting nearly as many rides as they used to. I think one of the benefits that we have now, where inflation isn't going to show up right away, is that the rest of the world is still looking at America as the place to invest. So it is keeping the dollar fairly strong compared to all the other countries. So that's going to help us, at least in the short run. When these other countries start getting back up and producing again, that inflation might start hitting us because of all the money we're printing. But you're right. We're going to have a shift in the industries. It doesn't mean it's going to go. Certain industries are going to go away. Certain businesses are going to go away. But I think other businesses are going to take up the slack. It's all going to be, to me, it's going to be behavioral. Things are going to change, and fortunately, we're in the business that we're all fairly nimble, that we can change along with it, right?
I'm gonna.
How about you?
Well, I'm gonna forego the last question, and if it's all right with you, Bill, I want to open it up and say, is there something that any of you guys want to talk about, something that we haven't covered, or you think that's important, or something that's worthy of being discussed at least? I'd like to open it up to you guys and hear your questions, concerns, comments.
I'll say something. In every, nobody wishes a downturn in America. Nobody wishes it.
Mhm.
But we have one here, okay? And usually during these times, it's the greatest wealth transfers that are out there, right? For those who are strong, who survive, like I say, the opportunity is going to be unbelievable on the other side. And I believe, like I say, there is a silver lining to this thing, and I believe that, like I say, there's going to be a lot of money to be made in the next 8 months to a year and thereafter. And honestly, what I think is going to happen is, and it happened in 2008. The weak are purged out, and that's in some cases that's a good thing. Those are some people that aren't doing business right, people that don't take care of things correctly and stuff. They're probably not going to make it, and that's not necessarily a bad thing. So I think the people that do business right, that are strong, they're gonna reap the benefits from this unfortunate crisis. That's what I think.
Thank you. Yeah, thank you for that. Anyone have any insights they'd like to share?
Yeah.
Yeah.
Yeah, I'd second what Glenn said. I was kind of thinking along the same lines because I didn't want to seem so doom and gloom after the last comment, right? But I really do believe that this is kind of that weeding out process. The most exciting part of any kind of recession or any kind of reset of any sorts is that the facade, right? The posers, the charlatans and things like that, they tend not to last, right? They tend to get weeded out during a time period like this. And I love seeing that there's going to be less and less deals to see. You'll see the people that actually are really good operators in the real estate side, like the people on this call right now, right? And I do believe you got to be patient, like many people said, is really watch, look for where the trend is going, watch for what's coming up, and watch for the opportunity. And I really do see this as an amazing opportunity to look forward to, to be engaged, that there's really not a shortage of opportunities even now or later. There's plenty of ways to actually profit and not off of sucking off other people, but profiting in a way that there's actually opportunity where you can serve and actually create solutions, right? I think we're all solution providers in a sense, and we're trying to do that. And the most adaptable of us, those of us that adapt the best to these times, are the ones that are going to come out on top. And that's what I'm looking forward to.
Yeah, that's awesome. I definitely agree with Chris. I mean, it's a shock to our system, but we will learn how to adapt. I mean, it feels like the economy is in a medically induced coma. I mean, the last time I think that we had a shutdown was like this was the energy crisis. So, we got past that, and it's just learning how to adapt, like Chris was talking about, and really, connecting with the people in your circle is only going to make you stronger, right? So, that's my 2 cents. I just think that people are just focusing so much on the doom and gloom and not really focusing on the opportunities that are around them, the connections that they're able to make now that everything is slowed down.
I have a couple of thoughts on the subject. So first, let me start that we all now is the power and the time for a prayer for our friends and family, and a time to remember our families. And I'm talking to my mother every day now, and it's really, really important now not to focus only on the financial ramifications of this, but more on the family and the impact and the relatives. And I'm in New York. I already have difficult situations, family members sick, some people, friends and families that pass. So just a reminder, life is fragile, and we have to do the best we can to spend time with your family and talk to them. If you can't connect, it is a little crazy that you can't go see your the relatives 3 minutes away because of the risk of the virus. That's the first point. The second point that I wanted to make: in every difficulty, there's an opportunity. So this is a difficulty, and like everybody else just said, this is certainly an opportunity to do a lot of good things. So it's an opportunity for people, especially the doctors and the nurses and the ambulance people. They're doing great service for the community. It's an opportunity to recognize them and say thank you for that great work. It's very important. It's very difficult times, but they are serving, and we all need to think how can we serve the community. And certainly we folks on this broadcast are all well off. We're all doing fine, and we will find great opportunities in real estate and do very well. But again, I wanted to focus the last message. It's a prayer time, it's a family time, and it's time to serve the community. Really, really important.
Well said.
Yeah, I totally agree. We do get focused on the financial and business side of the things, but we still have to remember that this is affecting real people. There are people that are passing away, and it really is a shame. It's not just about the financial, but you have to pray for the families, pray for everyone to stay as healthy as possible. Our frontline health workers. I mean, there's people in that industry that, they're making minimum wage that are out there exposing themselves as well.
Yeah.
Think of the folks that are in the grocery stores and, keeping us all fed, and the delivery folks for the restaurants as well. I mean, all those people are sacrificing as well. So those folks that are watching us, don't forget to like, share, subscribe. We're going to be doing this every Thursday, same channel, same time, for the foreseeable future, because we want to.
And not always the same guests.
That's right. Jonathan will probably not be here next time.
Kicking me off.
So we try to get perspectives from a lot of different real estate investors as well. Where I would like to touch on something that Mike had talked about last night. You guys weren't on the call last night, so we'll save it for the next round. But if you're in a fund and how you're thinking of your investment going for the next quarter or the next 4 quarters, and what your fund managers are having to do to make sure that they're staying safe as far as protecting from downside, and having plenty of reserves that are set aside, because there are going to be some short-term delinquencies, and how do we do that without interrupting the returns?
Yeah.
So, guys, thank you so much for being on the show this week.
Yeah, you all were great.
And those folks out in the audience, hope to see you next week at the same time, same channel. Take care.
Yeah,
Thank you.